Welcome back to the Joe and Phoebe Money Show.
Hi Phoebe. What is the best stock valuation method?
I don't know which is the best. It is like asking which the best tool or the most important ingredient is to cook a meal. These methods or tools depending on what you are trying to do.
Let me then ask you, which stock valuation method do you use most often and why?
I like to use the PE multiple method as a shortcut and for comparative purpose.
PE is price divided by earnings. Low PE means the stock price is low for the same $1 of earnings, compared to high PE. And that is cheap. Cheap is good, right?
No. You need to pay attention. The key is to find out the reason why it is cheap, and ask if there will be any near-term trigger that will make the stock price and the PE multiple go higher.
I'm sorry. Can you repeat, please?
You really need to pay attention.
Sorry. Let me take notes.
The key is to find out the reason why it is cheap, and ask if there will be any near-term trigger that will make the stock price and the PE multiple go higher.
Okay. Speaking out louder does not make it easier to understand. Do you mean, for example, a typewriter company's stock will remain cheap for a long time? Maybe even forever and beyond, until we both get old, because there is no or less demand for typewriters.
Correctamundo. On the other hand, a bank's stock PE multiple may be low because of a recession, and the trigger to buy will be when there are sufficient signs of an economic recovery.
This makes sense now. A few years back, I had bought a bank stock when it was cheap with a low PE multiple. Then it got cheaper and cheaper.
Yes. This is called value trap when bargain hunters keep seeing lower and lower prices. Wow. This is so unlike you, Joe. You always plan ahead. What were you thinking when you bought the bank shares at that time?
Now that I think about it, I wasn't thinking much at all. That was a terrible mistake. I should have waited for the trigger and look for signs that the economy is getting stronger. With that, banks will be able to lower their provision for bad debts, and this will flow into higher reported earnings. Plus, with the economy stronger, there will be more opportunities to give out loans with less default risk.
Yeah. Looks like you should review the handouts from our Econ Tech class.
Really? Must I? Do I have to?
You don't have to. Life is full of options. You can work hard now and retire early. Or
you sound like my mother and my father. Like the wonderful lady I am going to marry.
Huh? What did you say?
Nothing. Anyway, how should we think about high PE? For the same dollar of earnings, the stock price is higher than that with low PE. Expensive? Sell?
Not necessarily. I like what we had learned in our global financial markets class when we were at the university. High PE means high optimism or high expectation. We need to figure out if the optimism is justifiable. Is this company successfully gaining market share or able to reduce costs?
Of course. As Professor Chia always reminds us, are there any good data to back up this expectation or story? Without data, it is just a shot in the dark. And how do you use the PE multiple for comparison purpose?
We can only use the PE multiple when comparing companies in the same industry, preferably of similar size and similar business model.
Yes. Just like if I were to compare prices of different houses using price per square foot. I cannot compare one in Manhattan with one in Boise, Idaho. All these make sense now. Thanks. I cannot thank you enough.
Sure you can. I'd like my coffee black with 1 sugar. Please.
Anything for you, my dear.
Huh? What did you say?
Nothing.
This presentation on Stock Valuation Using the PE Multiple Approach is brought to you by the Joe and Phoebe Money Show.